The smartest people on the planet built rules for how the economy works, and the economy ignored every single one. Here are 10 things in the economy that should not exist according to theory, explained by Caveman. Number 10. Negative interest rates. Caveman put gold ore in the cave bank. Cave banks say, "We hold it, we give it back, we give extra for letting us use it." That extra, that is interest. That is the deal. It has always been the deal. But Japan, Denmark, Switzerland, parts of Europe, their central banks set interest rates below zero, meaning the bank charges the person for storing money, not pays, charges. Basic economics says savers need a reward. Without a reward, people do not save. Without saving, banks cannot lend. Without lending, the economy stops. But the Bank of Japan held rates below zero from 2016 until 2024. The European Central Bank did the same for about a decade. The rule said interest rates cannot go negative. Reality said, watch this. Number 9. Bad news, rising stocks. If berry bush has no berries, berry bush is worth less. Simple. But in the economy, sometimes the bush loses all its berries and becomes worth more. Companies report bad earnings. Stocks go up. Fewer jobs added than expected. Markets rally. It happens because bad news makes investors think the Federal Reserve will cut interest rates, which makes borrowing cheaper, which makes stocks more valuable. So the stock goes up because the news was bad. The bad news became good news. Traditional theory says prices reflect the actual value of companies, but what is actually moving prices has nothing to do with the company at all. Caveman confused. Caveman, go lie down. Number 8. The yield curve that cried wolf. Economists have an omen. It is called the inverted yield curve, when short-term interest rates end up higher than long-term ones. Every U.S. recession since 1955 was preceded by one. Every single one. The yield curve inverted in July 2022 and stayed inverted for over 2 years. Economists, banks, and the financial media all said recession was coming, but it did not happen. The economy kept growing. Unemployment stayed low. The omen fired. The mammoth never came. Number 7. The equity premium puzzle. Over the long run, U.S. stocks have returned around 6 to 7% annually. Government bonds return closer to 1%. Economics says riskier things pay more. That part makes sense. But researchers Mara and Prescott showed in a 1985 paper that the gap is far too large to be explained by risk alone. For the math to work, people would have to be so terrified of losing money that they would barely invest at all. But clearly they do. The gap is real. It is confirmed by a century of data, and nobody has a definitive answer for why it is so big. Number 6. The Paradox of Thrift. Saving money is good. Caveman saved dried meat for winter. Caveman survive. But economist John Maynard Keynes asked, what if everyone saves at the same time? When people spend, that spending becomes someone else's income. But if everyone saves at once, spending drops, businesses make less, workers get cut, and those workers spend even less. The thing that is smart for one person becomes destructive when everyone does it together. This was observed during the 2008 financial crisis, when saving rates jumped and the broader economy collapsed. The rule says save more, be better off. The economy says it depends on what everyone else is doing. Number 5. The diamond water paradox. Water keeps people alive. Diamonds are shiny rocks. But diamonds cost far more than water. This stumped economists for centuries. Adam Smith wrote about it in the 1700s and could not fully explain it. The answer finally came in the 1870s with marginal utility. Value is not about total importance. It is about how much the next unit matters. Water is everywhere, so the next glass is nearly worthless. Diamonds are rare, so the next one is valuable. Simple. But it took about 2,000 years to figure out. Number 4. The January effect. A company does not become more or less valuable because the calendar flipped to January. But for decades, stocks, especially smaller ones, have gone up more in January than any other month, documented in data going back to the early 1900s. The likely cause is tax law selling. Investors dump losing stocks in December to cut their tax bill, then buy back in January. But here is the problem. If everyone knows about it, smart money should trade on it and erase the pattern. That is what efficient market theory says. And yet the effect keeps showing up, even after being widely published. Number 3. Giffen Goods. The law of demand says, price goes up, people buy less. It is the most basic rule in economics. But a Giffen good breaks it. When the price rises, people buy more. It happens with cheap essential staples that poor households depend on. When potatoes get more expensive, a poor family has less money overall. So they cut the small luxuries entirely and buy even more potatoes because it is still the cheapest way to stay full. Price went up. They bought more. The law of demand just got kicked in the shin. Number 2. Asset bubbles. Efficient markets are supposed to be smart. Millions of rational buyers and sellers producing prices that reflect reality. But then bubbles happen. Companies with no revenue, no product, sometimes no plan, worth billions. Houses in towns with no jobs, worth more than a surgeon earns in a year. And then, pop! Alan Greenspan warned about irrational exuberance in 1996. The dot-com crash came in 2000. The efficient market hypothesis says bubbles should not exist. If a stock is overpriced, smart money should bet against it and bring the price down. But in a bubble, even investors who know it is a bubble keep participating, because the price might still go up before it crashes. The people who know it is a bubble help make it bigger. Number 1. The trade deficit that won't die. Caveman tribe has rule. Trade must be equal. If tribe always gives more than it gets, tribe gets poor. The US has run a trade deficit almost every year since 1975, buying more from other countries than it sells. For 2023, the goods trade deficit was around $1 trillion according to the US Census Bureau. Theory says this should weaken the dollar, close factories, and eventually force the economy to correct itself. But the deficit has only grown. The dollar remains the world's primary reserve currency, and the US is still the largest economy on the planet. The reason is the Triffin dilemma, named after economist Robert Triffin, who predicted in the 1960s that the country whose currency the world relies on will always run deficits, because supplying that currency means spending more abroad than it earns. The deficit is the price of being the most trusted. The rule says deficits weaken economies. 50 years of data says otherwise. That is what makes economics alive. Not the rules, but the things that keep breaking them. With that said, see you on the next video.